So I'm Jessica Levesque. I'm the executive director at C4. And our topic today is from bull runs to taxes, trading Bitcoin without the handcuffs. And so let's start with introing our committee members, and then we'll get into our special guests. So Dirk, you want to get us started?
Yeah, Dirk Anderson. I'm the chair of the Certified Bitcoin Professional Committee. I also sit on the CCSS, the Cryptocurrency Security Standard Committee here at C4. And yeah, that's really probably all you need to know about me. So I'm super happy to have some, hopefully, not hopefully, I'm certain, very interesting guest on today to talk about a couple of very timely topics.
And we've got your Bitcoin white paper behind you, so I feel like that adds in what we want to know about you. Your love for crypto.
Yes, always.
So, okay, Hunter.
And I'm Hunter Albright, also a member of the CBP Advisory Committee, and excited for the conversation today.
Okay, cool. And we're going to introduce our special guests in a moment. But before we do, I want to remind everyone that what you hear today is not financial advice. It's not tax advice. We're giving you information, but we are not your advisors. So keep that in mind, that this is just about trying to learn a little bit more. So let's start with Faiz. Faiz, will you introduce yourself and share a little bit about what you do?
Yep, thank you very much. My name is Faiz Rasool. I am essentially a trader. I've been trading crypto for over 8 years now, in and out of retail trading, and now more so institutional. For the past few years of my life, I've been kind of leading the asset management at a pretty major crypto lending company. Prior to that, my background was in traditional finance, kind of working in research for a couple of hedge funds and working in risk modeling. But yes, very glad to be here today, and I look forward to discussing more.
Awesome. Thank you so much for joining us. We also have Max, and Max is going to be focusing on the tax side of things. Max, you want to introduce yourself, please?
Sure. Thank you. My name's Eric. Can we? Just making sure I'm okay. My name is Max Markoff. I'm an attorney. I work for the Gordon Law Group. We're a firm based just outside of Chicago, and I've focused almost my entire career on taxes, specifically as they relate to crypto. I've also worked a little bit in hedge funds as they relate to digital assets, but this is crypto taxes, how I spend quite a bit of my time.
Okay, cool. Full transparency, taxes are my worst nightmare because of using cryptocurrency. It is complicated. So I think that this is going to be super insightful for us to learn more. And yeah, let's get started by just talking about how this is not a get rich quick session. We're not teaching you how to pump and dump and, cover things up, whatever. This is just about how do you do things the right way. And obviously that depends on your jurisdiction. But we want to make sure that anybody who's watching walks away with some general knowledge of what to do with trading, what that can look like, and what the interplay is between taxes and trading. So why don't we talk a little bit about trading to start? Faiz, why don't you just give kind of an overview, maybe like top 5 things to know about trading, or top 3, something like that.
Yeah, I was going to say maybe so from the starting point of, okay, now you own some crypto, what do you do with it, right? Versus if you don't want to just sit on it, what do you do with it?
Yeah. Thank you. So I would like to take it a step even before that, which is like, how did you end up with crypto in the first place? For a lot of us, how we end up with crypto, we go on Coinbase and we hit the convert button, right? And that's kind of a easy user experience. A lot of companies set up to kind of take the trading out of it for people that don't feel comfortable trading. But regardless of whatever user flow that you follow, if you have already bought crypto, or if you're about to, you're going to make a trade where you're going to trade your US dollars for crypto, whatever it may be. If you convert, it's still a trade. If you go to the supermarket, you buy groceries, you're making a trade. You're trading one thing for another, right? But once you do end up with crypto, there's multiple things you can do with it, right? There's different types of consumers that you can look at. There's institutions and there's retail, right? As a retail user, what you're only ever going to end up doing most of your time is exchanging either dollars for crypto or crypto for dollars, right? Back and forth. And that's kind of the most simple transaction that goes on, right? The other participants in the trading space are institutions. And these are either, producers like miners, right, for example, or mass consumers, right? That's whether, your prime brokerages, your lending companies, your, kind of institutions that interact in the space. if you want to think of Bitcoin as a commodity and miners as the producers of the commodity, miners have a very real need to trade every month because they have bills to pay. And we're not quite at the stage yet where electricity companies will let you pay in Bitcoin. Maybe in some corner of the world, correct me if I'm wrong, but not yet, right? So miners have capital expenditures, right? And they come to companies such as, OTC desks, which, to remove the jargon, is just a desk that you kind of settle a large transaction with. Or they might go to the market directly and say, hey, let's just think of the huge companies here, companies like Riot or the other bigger mining companies. They'll have hundreds of Bitcoin that they'll need to sell that will, essentially need to be traded on the market. The other side of that is, consumers, your lending companies, for example, the lending company that I was working at. And these might be companies that kind of foray into the world of derivatives, right? And derivatives, obviously, as they are in TradFi, are a little bit more complex in crypto, but they essentially allow institutions to leverage up, right, to kind of take advantage of structured products. But without getting too far into that, essentially, that is just one other form of trading that another type of participant uses, right? So from the perspective of trading, there's what you can do with trading kind of depends on the type of participant you are, right? If you're a retail trader, you're going to often find yourself trading mainly in spot, in and out, trading your fiat currency for crypto, your cryptocurrency for fiat. There are some venues to leverage up on that and kind of borrow and kind of buy more Bitcoin than the dollars you have, although I don't think too many of
I think he's having some bandwidth problems, but it'll probably come back around. Oh.
Yeah. So sorry, is my internet connection going?
You bounced out for a second, but you're back now. But actually, Faiz, there's something that you brought up that I wanted to kind of touch on a little bit more, which was that if you are paid in crypto, you have to trade it in order to use that to pay your bills. So if I'm paid in USDC, ETH, or Bitcoin, which I have been paid in all of those, that is my income, but I can't pay my mortgage or my electric bill or anything like that with Bitcoin yet. So it is considered a trade in order to be able to use it. So Max, I thought maybe you'd be able to add in a little bit about what the tax implications could potentially be for something like that.
Sure. Yeah. And that's a really good point. So typically, every time you get paid in crypto, you have income, as you pointed out, ordinary income, not capital gains. And how do you figure out how much income you have in US dollars? Because on your tax return, you don't, tax returns are in US dollars, no matter what. You have to report all of your trades in crypto and stocks, but ultimately you have to figure out a US dollar. And typically when you get paid in crypto, you have income equal to the USD fair market value at the time that you receive it. If it's USDC, as you pointed out, you've been paid in, that's pretty easy, right? How much is the USDC worth? Typically 1-to-1. And then when you sell your USDC, you still have to report the trade or the sale of your USDC on Form 8949. The only thing is you won't have a capital gain. Assuming that it's 1-to-1, you'll have your cost basis as $1, your fair market, the proceeds is $1, and your gain will be 0. But those are sort of the two reporting things you have to be aware of when you have income as crypto, the income event and then the sale of it. And it gets trickier when you have assets that fluctuate a lot more in value, Bitcoin and ETH, or any other coin that you can imagine, right? The value of a crypto one day might be very different the next day. But even still, you have income in Bitcoin, say, at the time you receive it. And then you have to report the sale when you sell it and the corresponding gain or loss. So that's sort of what you're working with as far as getting paid in crypto. And it's especially true for businesses, right? I mean, businesses could be receiving tons of payments every day. And so it's, having record keeping and good bookkeeping is insanely important.
So that sounds really important, right? Like if you're doing a trade there, so like you said, so if I get some Bitcoin, first of all, I have to know what the value of that was when I got it, right? Because that's my income. Then when I go and trade it in order to get US dollars or something to pay my mortgage, like Jess said, then the difference at that point I'm going to be taxed on as well, right? Now, if it's gone down, I potentially pay less tax, right, or take a benefit from that. But if it's gone up, I'm paying tax on that additional amount at the time that I do that as well. So it's not as simple as with dollars, right? I got this money, and at the end of the year, I just look at how much money I got, right?
That's exactly correct. And you could get paid in crypto and decide, hey, I got paid $50,000 in crypto. You have $50,000 of income at that time that you receive it, but maybe you want to hold on to that crypto. Maybe it's Bitcoin. You figure that 3 years from now it'll be 3 times as valuable. You still owe you still have the tax liability on it, but then you're not going to record the sale until 3 years later in the example that I just gave. You still have to come up with the money otherwise, and that's sort of where people find themselves in precarious tax positions where they have income, a lot of income in crypto, say they're staking quite a bit. And at the time that they're staking or getting paid in income, doesn't matter, any kind of income event, they're receiving a lot of crypto when the value of that crypto is particularly high. But then when they're going to, maybe 6 months later, think of selling some, pay their taxes, the value has dropped precipitously. The value of the crypto might not be enough to sell to cover the taxes. So it's prudent to know the value of the crypto when you're receiving it. There's, the value could go up or down when you get it, as you say, and depending on how much it goes up or down, could have significant tax implications.
Basically, the volatility of Bitcoin makes it even more challenging because you have to really keep track of how it's going up and down based on when you earned it or bought it versus when you're trading it, selling it, using it, whatever those things are. So it sounds like there is, or well, I know because I have been paid in crypto for years. It sounds like, and I know there's a lot of things you have to keep track of. It's not something that's as simple as, oh, here's a W-2 my company gave me, and that's kind of the end of it.
Absolutely. Yeah, absolutely. And people could have income from various sources, right? Maybe they're staking on Solana and they're earning income that way. Maybe they're getting paid in crypto for their work. You could have all different sources of income of crypto, and then you could also be trading crypto. You might also have crypto that you're holding long-term, that in your mind, you're saying, okay, I hold this crypto separately. I'm aiming to sell it to gain a long-term capital gains benefit. It has a lower cost basis. All of those factors are at play in trying to organize your crypto as a business. And whether you actually are a business or you're just a person who engages in crypto, from a tax perspective, you have to kind of treat it like a business. There's a lot of moving parts. There's a lot of things to keep track of.
Yeah. And well, I was talking about how I get paid in crypto. So that is a lot less to keep track of than if you're trading day in, day out, or even more regular, in particular, if you're using a lot of different types of currency. So Faiz, how would someone keep track of their trading in general, especially if you're doing a lot of things, or like you said, for a company being responsible for that? What does that look like?
Right. So obviously where you trade tends to be on an exchange. In crypto, you don't really have as much of a broker dealer and exchange segregation, not yet, maybe in the future. So the easiest place to keep a track of your transactions would be, your order history on an exchange, right? And they kind of are they're very comprehensive. They go back as far as you need to. If not, you can always request them from the exchange. There's software to help you do that, such as Luca, that we've used in the past as well, to kind of aggregate exchanges, right? So maybe you trade on, and we'll get into the complexity of it, but maybe you trade across multiple exchanges, right? Maybe you sell your Bitcoin on any given day on an exchange where it's trading highest, because obviously you want more dollars when you're selling your Bitcoin, right? There's various tools that allow you to kind of aggregate those histories, but at the end of the day, what you kind of need to keep track of is your transaction history, right? And that goes as granular as every single order you've ever placed, right? Ones that don't even get filled. That doesn't really have any. Well, I'll let Mark speak about it, but that doesn't really have any tax implications. But with regards to your actual trades, you're able to get your your trade history, which is as simple as like how much Bitcoin did I buy and sell between this date. And you can break that down by currency and obviously, you know, whatever different treatments that you may have. And that obviously has things such as your realized profit and loss, right? So the things that we're talking about here, and especially as we get into derivatives, right? If you have an open position, you close it after a certain date, how much money did I lose on this, right? And that makes, you know, Max's life a lot easier because then he'll be able to see, compared to where you bought this, where you sold it, what is the capital gains or capital loss that will come into it, right? So on any given exchange, you'll have your exhaustive transaction history that you can use for tax purposes.
So one of the things you said there, Faiz, that I think is interesting is just the reference to the like all the different exchanges, right? Somebody who's maybe more familiar with, you know, stocks, you know, and trading there, you know, you buy a stock on the New York Stock Exchange, it's only available on the New York Stock Exchange, and you're going to trade it on the New York Stock Exchange. Maybe you could talk a little bit about just what kind of like the global exchange infrastructure looks like and why you go to one exchange over another or that sort of thing.
Yeah, for sure. So crypto in terms of, you know, let's just talk about spot Bitcoin, spot Ethereum, just spot crypto. It's fungible. You can move it from one exchange to another and you can sell it, right? Think about if you have shares with one broker dealer, you kind of move those shares across to another broker dealer because you like that broker dealer a little bit more, right? Ultimately, you'll end up executing in the same exchange, but as far as crypto goes, crypto exchanges tend to be their own broker dealer, meaning that you can trade directly on the exchanges. The global infrastructure, as far as today is concerned, a lot of the volume is offshore, right? Think of your exchanges such as Binance, OKX, Bybit, Deribit. Obviously, Coinbase is a major one onshore, but the majority of volume today, I would say in the spot market, is executed offshore, right? So the way the infrastructure works, for example, if I'm holding some Bitcoin and why I would choose one exchange over another, it could be a multiple reasons, right? One is price, right? If I don't have a lot of Bitcoin to sell and I have access to 5 exchanges, I'm just going to go sell it, you know, given that I like making money in my trade, I'm going to go sell it on the exchange that is trading the highest, right? Another consideration, let's just say I'm someone that holds a lot of crypto, that liquidity, right? So how much can I sell across an hour on a given exchange for the most, right? So if I'm kind of looking at an exchange and I only trade like 5 Bitcoin a day and I have 100 Bitcoin to sell, regardless of the price I'm getting for that, I'm likely not going to make the decision to sell on that exchange because I just won't be able to make the transaction that I need to make, right? So that's what we call liquidity, and that's also a very important consideration. The other considerations you can take into account is your counterparty risk, right? Everyone, I'm assuming, will be familiar with what happened with FTX. We all have our own due diligence procedures, and I'm sure, you know, there's a lot of useful resources out there for that, but do I trust myself to put my crypto on this exchange, right? So to give you an example, I don't hold any crypto on Huobi, right? It's a foreign exchange. Regardless of what price you're going to pay me, that's not enough of a risk premium for me to hold my crypto on that exchange. So I will not. And this isn't by any means a slander or a endorsement, but personally, that's just not an exchange I'm registered on or can trade on or would trade on. And you can kind of take that for anyone. So risk tolerance is another thing, right? Especially when dealing with offshore exchanges, given that if you are in a position to do so. So I think those are the 3 main ones, right? I would say the price you can realize for your crypto, liquidity, depending on, you know, if you have an obscure token as well, can I sell it for the size that I need to sell it? And last, security, right? It should always be security. You should always aim to be as sovereign with your crypto as you can. Kind of, you know, do your due diligence in the exchange that you deal with, and kind of, you know, go from there.
So I want to hear in a minute from Max about what happens if the funds are lost in some way. But Dirk, I thought maybe first you could talk a little bit about the cryptocurrency security standard at C4, since you're on that committee, and address what Faiz just said about where you're storing your crypto if you're not holding it yourself, but putting it on an exchange.
Yeah, absolutely. And that was something that I was thinking about as well as he was saying that, right? That, you know, you want to be as sovereign as you can. It's a great plug to go back and watch the CVP. We've done a couple of sessions around wallets and holding your crypto and managing your crypto and how to secure your crypto, first of all. And then, yeah, from an organizational perspective, the CCSS addresses very specifically the security controls that an organization should have in place if they're handling other people's crypto in particular, right? And The big focus there is around key management, who has access to the funds. And it's important to know, I think, on an exchange, you're going to be dealing with hot wallets, right? But just by the nature of how an exchange works, they need to move the crypto quickly. You need to be able to deposit it. They need to be able to convert it from one thing to another. So they're going to keep reserves, potentially in, more secure cold wallets. But the crypto is going through a lot of hot wallets. And if you're bridging on an exchange from one network to another with like wrapped Ethereum or something like that, wrapped Bitcoin onto Ethereum, you're gonna there's to Fez's point, right? There's additional risk in all of those things in the way that you go about picking what you're trading as well. So it just many more things to take into account ultimately. But
so if you put your money on or your Bitcoin on an exchange, if you're holding it there and that exchange loses the keys or any circumstance like this, like there have been hedge funds or staking pools where you are lending your cryptocurrency to a different organization. It's your money, you earned it, but then you're putting it somewhere. What happens if, let's say, like with Gemini, if you saw a while ago, they used, I can't remember the name right now, but all of the people who staked the GUSD lost that money. I think it was called Earn2, something like that. Do you still have to pay taxes on money that you earned and then staked and somebody else lost? Or what would that look like, Max?
It's an interesting question. And it's a question we get fairly often. And I'm definitely going to emphasize the point here that this is not legal advice, right? Just because there's several options, and a lot of it can come down to how aggressive you want to be in trying to take losses on your return to get money back, right? Because that's going to be your like reprieve from a tax perspective, right? How do I get compensated for this? Well, I want to take a loss on my return. And it's going to be a matter of how aggressive or conservative you want to be. I mean, your option is always you could do nothing. Other options are to try and potentially treat the crypto that is lost as worthless and to try and take a loss equal to your basis in the crypto. That's potentially an option. And I think one important thing to keep in mind when it comes to crypto, some things from crypto in a tax perspective are very simple, right? When you sell one crypto for another crypto, that's a trade that has to be reported, right? Several income events in crypto are pretty settled, right? But as far as other things like how to take losses in these unique situations, we're taking tax code that's decades old and applying something that's very new. For example, and I think a really relevant example is you mentioned Gemini. We also deal every day with people who have losses from Celsius, from FTX. And they call us and they say, I saw online that people are taking this thing called a Ponzi loss on their tax return for 2023. Can I do that? Well, that's like an insanely aggressive position to take. Is it viable? I don't know. I don't know. It's very fact specific. It kind of requires an analysis. Some people out there are saying that they're doing. I guess what I'm trying to say is by bringing up that Ponzi example is that type of loss was created in 2008 and 2009 in response to Bernie Madoff. Now, 15 years later, people are saying, hey, what if that applied here to crypto? I don't know. There is no way of knowing. But I mean, there are different avenues in the tax code for trying to take losses, a couple that I've mentioned. The other factor to consider is that losses typically have to be considered complete and final. Well, in the instance, I don't know about Gemini specifically, but in some of these bankruptcies, some of these bankruptcies are still being paid out. So if you take losses on a crypto that you lost, but then you get some of it back, well, then what's the result? The result there is that you have income because you already claimed a loss. You don't then just get to have like free income that you don't pay taxes on. So that's another thing. People, maybe you want to make sure that you take your losses at the appropriate time and in the appropriate tax year. Timing is everything. So there's a lot of moving parts. There's a lot of different factors to consider, and it's always just a fact-specific inquiry. And I guess another important thing too that we get, I think I get a question all the time, especially about this. Someone says, I filed a loss on my tax return a certain way, and I didn't get audited. So that means the IRS says it's okay. That's not true. I mean, the IRS, just because the IRS doesn't audit you doesn't mean the IRS is endorsing a position you took on your tax return. It just means you didn't get audited.
That
So
just
careful.
like scares me that people think that. I don't know. I don't love dealing with my taxes, but that was just like my eyes just went wide thinking, oh God.
Right. I mean, just because your friend did something doesn't necessarily mean that that applies to you,
Yeah.
or that they were right in the first place, or that they got good advice. I mean,
Or you got away with it doesn't mean that it was okay or that you will in the future, whatever. Yeah.
right. I mean, the IRS is always issuing guidance. They're issuing, I mean, all the time. They're analyzing these situations as well. And I'm sure, whatever. I guess my point is too, is that it's an ever evolving situation when it comes to a tax perspective from crypto and what the IRS will accept and won't accept.
Yeah, absolutely. Hunter, you have done a lot of consulting for years in different ways, and been involved in Bitcoin and other currencies, whatnot. What about what we're talking about sparks, I guess, something within you, either curiosity about this or an experience you've had related to trading Bitcoin or Bitcoin taxes, anything like that? You want to jump in?
Yeah, I would love to go back to actually the example you brought up earlier about getting paid in crypto. And I think this could be for individuals or businesses. And really for Max and Faiz, would love for you to think about and share some tips, right? If people wanted to hold that crypto, and to the point earlier, because of the volatility, there is a potential liability if the price were to drop, that they would still be liable for the taxes on the higher amount. I mean, what could people do to both be better prepared for that, so that when tax time comes, it's not so much of a surprise, and they're not necessarily, unprepared for making the payments that are required or providing the adequate documentation?
Me or Faiz?
Max, you can start. Let's start with you.
Sure. I guess there's a few options, right? I guess in a perfect world, you would know I received crypto as income and you received it in a volatile form, Bitcoin, ETH, not just stable coins. And you're thinking to yourself, okay, I know I have income at this amount. I want to make sure that I have enough to cover the taxes. In a perfect world, you would potentially set aside enough money or maybe sell a portion of it to set aside to cover taxes or sell it into stables. Because although you have a capital event for selling the crypto there that you have to report, shouldn't have fluctuated too much. So there shouldn't be much of a gain or a loss. And you know that you have the funds aside to pay your taxes. But there are other things you can consider from a tax perspective to guard against the situation, or to, I guess maybe even to react against that type of situation if you find yourself in a situation where you have a lot of income in crypto, but you don't necessarily have the funds to pay your taxes. The IRS really does care a lot about filing your return. Just because you're worried, oh my God, I'm going to have a huge tax bill, they still want you to file, because the tax deadline is always two deadlines. It's the deadline to file and the deadline to pay. So you should still, A, file your return timely. Just because you're scared you might have a big tax bill, file on time. And second, you can always enter into a payment plan. You can try and say, okay, well, maybe I don't have the funds to cover this now, but I can negotiate payment plan with the IRS. We do that. The IRS does that most every day. Because you may say that may give me enough time to cover this tax bill. The other option, and Faiz may even be able to speak more about this too, is you can also borrow against your existing crypto. Because say that you have a large tax bill and one of your concerns is, okay, well, I have crypto I can sell to pay this tax bill, but I'm going to in turn create an even higher tax bill. And when is an end? What did I get myself into? Oftentimes, there's platforms where you can borrow against your crypto without having to sell it. And then you can pay back the loan that you borrowed using your crypto as collateral. So there are different options. I guess the first one I said is a little more preventative, and those last two I said are sort of reactionary. What happens if I do have this large tax bill and I don't have the funds to pay? And what are some of my options? Those are two good ones.
Yeah, Faiz, did you want to make any comments on that part? Oh, you're muted.
Sorry, yeah, as always. So yeah, I would like to go back to Max's original point, which is, when you are getting paid in dollars or dollar equivalent in crypto terms, that is a trade, right? You are making the trade that where you are choosing to receive your receive your wage, salary, payment, whatever it may be in crypto in a crypto format. And then from that perspective, it totally does make sense to kind of review what it is essentially your portfolio, right? It would not be very prudent, and this is in financial advice, for example, when you have to pay your liabilities, such as taxes or whatever else, to have everything in Bitcoin, right? It makes sense to kind of set up your portfolio in a way so that, given the volatility of Bitcoin or any other crypto, if the price is to go down, you are still in a position where you can cover your liabilities, right? So whether that is setting aside dollars or setting up a portfolio for yourself with a financial advisor that works for you, that's definitely something that should be explored.
Yeah, and I think it's interesting when we think about. Oh, are you back?
The first thing I would say is that with Bitcoin land, yeah. So in a faraway world, we end up in Bitcoin land and your liabilities are in Bitcoin, then great. Then you can actually, then you don't have to worry about the conversion between Bitcoin and dollars, and then you're paying your liabilities in Bitcoin. But until we get there, you have to kind of always think about the interplay between the two currencies and how that kind of affects your portfolio. And then to go back to the point of lending, yes, of course, right? But lending is also not without its risks because it doesn't entirely remove the market risk, as we like to call it, that comes with Bitcoin, right? So if you are living, in a situation where the entire value of your paycheck is very important for you to make your liabilities, then that will be very different. Let's say your paycheck is maybe 10% of your liabilities, right? So it's very important for you to evaluate your lifestyle versus, the payments that you're receiving versus the crypto. Speak to a financial advisor, kind of come up with a portfolio that works for you, and then kind of go from there. But absolutely, if you want to kind of hold on to your long exposure, not sell the Bitcoin the moment you get it, borrowing is a great option. Tax efficient as well.
That's awesome. Thanks, Faiz. And I want to come back to something Max said, but I want to start by saying, so again, acknowledging that this isn't about getting rich quick, right? But we are talking about trading. If Faiz looks like he might be a little frozen, but if you can answer this, Faiz, maybe let's talk a little bit at least about trading crypto for crypto, right? Like, and so a lot of what we've been thinking about is trading back and forth into US dollar or, some fiat value that's appropriate to where you live. Talk a little bit about the actual trading process. Obviously people do this with stocks, they do this with crypto, right? Like, if people are trying to make money on exchanges, right? What does that look like? How do you look at crypto pairs and figure out trading and take that approach to actually doing trades?
Yeah. So yeah, trading crypto for other crypto can be very akin to trading a stock for another stock, right? So you can sell a stock or crypto for dollars or the stable coin equivalent of dollars in an exchange, and then just use those, dollars to go and buy another crypto, right? That's the most traditional way of doing things. Where crypto kind of, goes a little bit further beyond is you can kind of trade crypto versus crypto, right? So you can trade Bitcoin directly for ETH in a Bitcoin versus ETH pair, right? And why you would do something like this is like we've all been keeping up with the news cycle. The Bitcoin ETFs just came out, right? So one possible view I could express is, hey, I think Bitcoin is done going up. What I want to do now is I want to position myself in ETH because, I think ETH is going to go up because the ETFs are going to come out, right? So that's a very real trade I can make on that exchange where I can go and sell my Bitcoin either for dollars and then use those dollars to buy ETH, or alternatively, I can trade a Bitcoin versus ETH pair and sell my Bitcoin and change my exposure to ETH, right? Now, a question I would have myself is what is for Max is what is the tax treatment difference between the two, right? So if I choose to go and sell my Bitcoin for dollars and go buy ETH with it versus if I directly, what I would say, call it a swap or a cross-currency trade from Bitcoin to ETH, what's the difference between the two in terms of tax treatment?
Really good question. And this is sort of one area from the IRS tax perspective that I think people do feel fairly comfortable on. The treatment of trading Bitcoin for ETH in your example is treated as if, from a tax perspective, as if you sold the Bitcoin for cash and used the cash to buy ETH. Whereas you presented another example is, what if I just sell the Bitcoin first, then use that cash to buy the ETH? From a tax reporting perspective, there is no difference. Crypto to crypto trades are treated as if you sold the first one for cash, purchased the second.
So related to that, my kind of second half of that question for you, Max, was how does it play out, and from a tax perspective, like, so if I'm doing the trading myself, right, and then what you just said makes perfect sense. How does it play out differently if you have like a broker doing trading for you, right? So if I hand all of my crypto over to somebody else and say, hey, I want you to, manage trading this for me, right? Is every trade still count as profit and loss, or is it more like stocks where you just recognize the value when you take value back out of it, that sort of thing?
It's a good question, and I might not be entirely sure on it, and maybe more facts would be needed too. I guess, does this brokerage sort of act as like a fund where a bunch of people are contributing, and then at the end of the year, you're getting sort of just like a statement of, you're getting a statement at the end of the year. I think in that instance, you're not keeping track of the individual assets. It's more of like a fund. Usually in a fund, you're getting some sort of documentation from that fund. That's sort of my best answer that I have at this point.
Well, and I think that just shows that there's so much, I don't know, so many specifics and differences, and there's so many dependencies when they're trying to figure out taxing and or trading and taxes. There's just so many different components of it. I have another question that is related to both trading and taxes. If you get an airdrop of a random token or an NFT or whatever it is, you receive it, what is your responsibility for taxes? But also, I guess it would relate to if you've traded it, sent it, what you do with it, right? But yeah, I don't know if there's much information on how that works.
Sure. I can take this from a tax perspective. Typically, airdrops are treated as income at the time that you receive it. And there's been similar to how if you get paid in crypto, the exact same way. In fact, the only difference might be in where on your tax return you would report it. If you're getting paid in crypto for work that you're doing, that's probably going to go on, if you're an individual, on Schedule C. That is business related income. That's as if it's your job. Whereas if you're just getting an airdrop, that's typically reported as other income, where you're not going to be subject to self-employment taxes on it. And I guess one question we get all the time is, if I look into my wallet right now, I have all these, or a bunch of these, little spam airdrops. Are you telling me all of these are income? A lot of times we tell clients it makes sense to maybe just pick them up as a penny in income, just so that you can report, hey, that I acknowledge this as income. And if it becomes an airdrop that actually becomes worth something down the line, well, you have a basis and a holding period, but then when you do sell it. So that's typically what we tell clients, but there have been, in recent years, many notable airdrops. Solana has had many notable airdrops. People have been airdrop farming, in the last year on Solana. Way back in 2020, there was the Uniswap airdrop, which is sort of the first one that comes to mind that I really remember, is people talking about. And that was, I think at the time, maybe $1,200. So some of them can be significant. You never know.
Yeah, it makes me think of like if somebody drops $1,000 off at your door and suddenly is like, you've got now $1,000. But what if they drop something off that they think is worth $1,000? Like, I don't know, a hutch from your grandma, I don't know, whatever, something, but you think that it's not worth anything. That wasn't a good example, but it's interesting to think about what you may not want something, but it's suddenly yours, and then it's taxable because you didn't want the airdrop or the NFT, and it's appeared, and
Right.
now it's yours.
It's usually fair market value, which for NFTs or any airdrop generally can be hard to discern. But especially for NFTs, like how are you valuing it? I mean, is it just the floor price? It's hard to say. But typically, in your example too, $1,000 worth $1,000. What is whatever that item was dropped on your porch worth? Maybe to them it's worth $1,000, but it's the fair market value of what you get.
Right. Yeah, and it feels very subjective of who thinks, it's worth what, is determining what the market value is, depending on what it is, because some people might think NFTs in general are worthless, and other people think that they are not. They're worth millions of dollars. So,
right, oftentimes too, we've looked to, for example, maybe what is the floor price of these NFTs on OpenSea? That's one viable way that you can think about, okay, how, what's the market? Well, the OpenSea is a marketplace for NFTs. That seems like a logical place to get a fair market value.
And Max, can you elaborate a little bit more on the importance of establishing the date when you might receive the airdrops or some of these additional tokens, and what potentially would be the implications of not anchoring that?
Sure. That has everything to do with whether or not, if in fact you do sell it, whether or not you have short-term or long-term capital gains. Capital gains are assets that you sell after holding them for longer than a year. Short-term, less than a year. And the tax implication there are the tax rate. Currently, the long-term capital gains tax rate is the most beneficial tax rate that you can pay. It's anywhere from 0 to 20%, depends on how much money you've made throughout the year, compared to short-term capital gains, which are taxed at the ordinary income tax rate, up to, 37%, 37.5%. So establishing a holding period is significant, depending on whether or not you're going to sell it and if you plan on holding it long term.
And that's why you were saying sorry, Tess. I was just going to say, that's why you were saying the importance of going at, like, if there's a possibility an airdrop might become valuable, it's important that you actually claimed it at the time that you got it in order to set that clock.
Right. Yeah. Because if in fact you were to get audited and the IRS is challenging the holding period or the gain on a particular item or several things, well, you're able to say, well, I reported this in income in 2021, and now it's on my tax return, and now in 2023 or 2024 I'm selling it, and so I can prove holding period.
Interesting. We had a question in the YouTube chat, which is, if someone inherited Bitcoin, is the receiver liable to pay taxes based on the value of Bitcoin at the time of receiving it?
Ooh, this is a good question, and I may not know all the nuances to this, but I can speak
Which
on
is
it
fine. This is not tax
Right.
advice, just conversation. So
Sure. And because there may be, like many things legally and from a tax perspective, there's probably several factors. But I know that it was phrased as an inheritance, but from crypto that's given as a gift, and I suppose inheritances can be viewed as a gift of sort. Typically, when you give a gift, it is not taxable to the person receiving the gift, and the basis and the holding period transfers to the giftee from the giftor. So if you gift me 1 Bitcoin, I inherit your cost basis and your holding period, assuming that you know it. And typically, it's a good practice to memorialize that with a gift letter, where you would say to me that you're giving me this as a bona fide gift, that it's not some sort of transaction, you're not getting anything in return, because then it's not a gift. And if you knew the information such as the holding period and the cost basis, then you would include that in the letter. And we do that for clients all the time, where they give gifts, but they have no idea what the basis is. And then along with other work that we provide for them, we can say, here's a gift letter for you to give the person who gave a gift to. The other side of the transaction is the giftor. Is it taxable to the giftor to give a gift of crypto? And the answer is, it depends, of course. Typically, you can give gifts to someone. I forget if it's $15,000 or if that number has gone up. But you can give gifts, say it's $15,000, in a year tax-free. You don't have to worry about anything. Once you give gifts in excess of that, say you give me $50,000 in Bitcoin, you would file a gift tax form that says this is, you gave a value of a gift, fair market value $50,000. In our lifetimes, we have a certain dollar amount of gifts that we can give tax-free. And so the gift tax form essentially deducts that from your lifetime tax-free gift limit. Don't remember what that number typically goes up. I think the last I heard it was around $13 million. I don't recall off the top of my head. But that's sort of, I know it was phrased as an inheritance, but I guess just from a general gift perspective, those are some of the factors at play.
So Max, just a quick follow-up on that. I mean, with equities, the basis typically gets reset when there is an inheritance and sort of value gets transferred at the death of somebody. Does that same rule apply to crypto, where the basis would be reset in that type of situation?
Yeah, that I'm not quite sure. I'm not quite sure on inheritances and those types of transfers of property. Not quite sure.
Well, right now, one of the big problems that we're having with Bitcoin and crypto in general is people aren't passing on their digital assets in a way where their loved ones can actually receive them. So the idea of getting this gift is great, but oftentimes people aren't doing the steps that they need to for crypto asset inheritance planning. So I just put a link in our in the YouTube for a book called Crypto Asset Inheritance Planning, which is fantastic. It's full disclosure by Pamela Morgan, who's one of our board members, but I don't think that reduces the fact that it's an excellent book. So if you want to learn more about how to make sure that your loved ones receive your crypto after you die, not before, it's worth a read for sure. So, Faiz, is there anything else about crypto? I mean, there's a lot, but anything about crypto trading that we have spoken about that you wanted to elaborate on?
No, I think we've done a great job in touching on most of the important aspects. Day to day, we all engage in trading in one form or another. Crypto is not really any different. The most common way of doing so is, dollars to crypto, whether it's Bitcoin, ETH, whatever it may be. I'm glad that we got to touch on a little bit the interplay between cross crypto transactions. Another kind of way of trading crypto, and for anyone familiar with the TradFi financial markets and the kind of futures exchanges and such as the CME and the Chicago Board of Trade, all those kind of exchanges, there's a very similar market in crypto, right? Which is you're able to leverage up. And for people who have ventured over to the degen side, where people kind of leverage up on their positions 100x or whatever it may be, there are responsible ways to kind of get into that as well, right? Which is, how can you leverage up your crypto when you're trading? I don't think that's quite within the scope of this, but just know that there's a whole derivatives market in crypto that is growing very quickly, and it has its own kind of treatment as far as taxes go. But we use it for a multitude of applications, such as hedging, borrowing, and crypto isn't just buy and hold crypto, right? Trading goes far beyond just buying and holding and swapping crypto, and it has some very real applications in the world of hedging, borrowing, and leveraging up as and when you need to. So there's a lot of useful resources there that I can share with you guys, and you guys can circulate. But yeah, I think that we've done a great job of covering most of the main ones.
Okay, awesome. Max, what about you? I know for both of you, there's so much more information we could share, but anything that you feel like you want to address further? Any points, takeaways?
Sure. I guess just one good practice or good habit to get into, as Faiz alluded to it earlier, is when he was talking about exchanges and platforms where you can access your transaction history. In order to be tax compliant, you have to report your transactions. And in order to do that, you have to have the histories. And we learned over the last few years that an exchange may go down suddenly and you may lose access to that. So it's a good practice to, I don't know how often, every month, a few months, every so often, to make sure you download those transaction histories. And usually the information you're looking for are not only trades, but withdrawals and deposits. Because also, as Faiz alluded to earlier too, is that these platforms or these exchanges don't really talk to each other. They might in the future, but if you have foreign exchanges and United States exchanges, those probably aren't talking to each other. So you need to get your transaction histories, trades, deposits, withdrawals from each of them. So I guess that's just one good practice. Reporting in tax compliance is important, but you can't do that if you don't have your history. So make sure you do that.
And one of the beautiful things about blockchain, of course, is that part of that data is always available, right? You can always go back and find when something moved on the blockchain, but that doesn't necessarily give you, the pricing and everything else that that it occurred at. And that's the piece that you need to make sure that you're capturing, right?
Right. And clients tell me that all the time is when we're asking for transaction histories. Well, it's all on the blockchain. Well, a lot of exchange transaction history is not in fact on the blockchain. And you may have had hundreds or thousands of trades within a platform, and then all we see is a deposit, into your wallet after a ton of activity has happened on the exchange. So yes, that is true. And yes, sometimes we can piece together transaction histories or make inferences or assumptions, but it's always a good idea to download your transaction histories from all of your exchanges. It's like insurance, like you'll never think that you need it until you need it. So.
Yeah, I like that comparison. Hunter, Dirk, anything else you wanted to say before we sign off?
No, I'd just like to thank you both very much for being here and having this conversation with us. I know it's one of those things where we could probably do 10 more of these on taxes and trading and still just be kind of cracking into all of the details. So appreciate you guys being here very much.
Thank you for having us.
Yes, likewise.
Yes.
Thank you.
So appreciate it. Thank you very much. And we'll put some more resources in the description notes. And thank you, Max and Faiz, for joining us, and Hunter and Dirk, as always, from our CBP committee. So thank you and take care.